Microsoft stock has gone from under $40 to over $400 in the last 10 years. It's the largest company in the world with a market cap of $3.2 trillion, and it is at the forefront of artificial intelligence with its OpenAI partnership, the maker of ChatGPT. And with its recent announcement with OpenAI of a $100 billion supercomputer, is now the time to buy this AI superstar. Tune in and find out. All right, there are three things that we are going to cover in this video. Number one, what is Microsoft's business model? I'll give you a little hint. It's very focused on the cloud and AI. Number two, we're going to get into some major acquisitions and partnerships that the company has engaged in. And then number three, what is the valuation of Microsoft? On Wall Street, we build a three-statement financial model culminating in a DCF or discounted cash flow valuation. I have built a three-statement model and think Microsoft is very attractive at current levels. So let's dive right in. Okay, guys, we have to talk about Microsoft's business model. There's three pieces to it. Number one is the business commercial side. It's about 33% of revenues. It's things like Office 365, Teams, Copilot, and even LinkedIn. It has a 14% growth rate over the last 5 years. Number two, their cloud business. Now, this is a business that currently is 41% of revenues. It's gone from 29 to 40% over the last 5 years, and it's growing at leaps and bounds, 22% growth rate over the last 5 years. This is basically Azure. Number three, the personal computing area, that's 26% of their total revenues. This has actually gone the other way versus the cloud. It was 38%, now it's only 26% of revenues. It has a 5% 5-year growth rate. This is stuff like Windows, content like Activision Blizzard, and search and ads through Bing and Edge. So what's the takeaway? Microsoft is laser focused on AI and has been since before COVID, as well as the cloud. Okay, next thing we have to focus on, acquisitions and partnerships. In 2016, Microsoft made a splash buying LinkedIn for $26 billion. It has grown 7x since the purchase by Microsoft. Revenues have gone from 2.3 to 15.1 billion. It's grown 24% per year over the last 5 years. Second, Activision Blizzard, there was a lot of controversy over this. It was a $75 billion acquisition completed at the end of 2023. This couples gaming content with the Xbox gaming system. Gaming is about only 8% of revenues and has grown 10% over the last 3 years. And then the big one. In 2019, Microsoft invested $1 billion in OpenAI, the creator of ChatGPT, and that brought AI to the mainstream, saw the fastest user growth of any platform in history. Now, at the end of March 2024, Microsoft announced with OpenAI the plans for an AI supercomputer called Stargate, launching in 2028 and costing upwards of $100 billion. Now, what's the takeaway here? Microsoft is laser focused on AI, has been since before COVID. Now, what are they focused on? They're focused on the UI or user interface aspect of AI, not the processing piece like NVIDIA. And here's the punchline, guys. The 800-pound gorilla in the AI space is Microsoft. Period, full stop, end of story. I'm super excited to see what they do. If you're enjoying this, please smash that like button. All right, guys, on to the valuation. So remember, I told you we build a three-statement financial model. The first of the three statements is the balance sheet. Now, a few key takeaways here. Number one, the company has tons of cash. It's had over $100 billion of cash over the last 7 years. Despite massive growth, there's very low leverage. They've reduced debt $25 billion or 35% over the last 5 years. And lastly, they've had a 5 times increase in retained earnings over the last 5 years. So what's the punchline here? They're very conservatively financed. They have a solid balance sheet and a AAA credit rating. That's better than the United States of America, by the way. Let's hop into the model. All right, guys, some key takeaways here from the balance sheet. So cash and cash equivalents, you see over $100 billion, and it's maintained that way for the last 5 years. Now, debt, here's a very interesting thing. Debt has actually declined significantly over the last 5 years, while retained earnings has increased significantly. So what has the company been doing? They've been paying down tons of debt, maintaining their cash, deploying it through acquisitions, and just massively ramping up their retained earnings. Okay, guys, next thing we have to focus on, the income statement. So a few key takeaways here. Revenue has increased 50% in the last 3 years and doubled in the last 5 years, all while decreasing operating costs on a relative basis. Net interest income, due to the invested cash that they're generating, is greater than the cost of their debt. The 5-year average tax rate is 14.5%. They've done an excellent job with tax credits, managing their exposures both domestically and internationally. So what's the punchline? The last 5 years, revenues have doubled while net income has grown 3.4 times. This means they have positive operating leverage. Their costs are not increasing as fast as their revenues. And don't forget, revenue is what you make, net income is what you keep. Let's hop in the model. All right, guys, so looking at revenues, we have a 92% growth rate over the last 5 years, a 48% growth rate over the last 3 years, just absolutely ripping. As I mentioned, they're net interest positive, meaning their interest income outpaces their interest expense. And then lastly, when we look at the net income here, 5-year growth 3.4 times. Their 3-year growth, 63 times. So both their 5 and 3-year net income growth outpaces that of revenue. What does that mean? They have major control over their costs, the likes of which I haven't seen any company do yet. All right, next we have the most important of the 3 financial statements. That's the cash flow statement. Now, a few key takeaways here. Operating cash flow has doubled over the last 5 years, driven primarily by net income. $208 billion of cash has been returned to shareholders over the last 5 years. Wait until you see where it came from. Also, there's been a massive increase in free cash flow, 84% in 5 years, 31% in the last 3 years. So what is the punchline here? Cash is going to be 12x what it is today by 2028, the end of our model. The $100 billion investment in Stargate is going to be funded with cash and cash flow. Let's hop in the model. Okay, guys, as I mentioned with the cash flow statement, an 84% increase in free cash flow the last 5 years, 31% the last 3 years. Something really fascinating, though, that we see here is when we look at what I mentioned a little bit earlier. So when we look at the cash that's been returned to shareholders, $208 billion over the last 5 years, check this out. From the cash that they've invested, that $100 billion of cash, they've made $301 billion. So effectively what they're doing is they're taking the money that they make in cash, they're investing it in high quality securities like treasuries, commercial paper, repurchase agreements, etc. They're making a return on that, and then they're returning what they get to their shareholders. Truly, truly remarkable stuff here. Okay, guys, next thing we're going to discuss forecast drivers and DCF assumptions. So a few key takeaways here. They have incredible cost control. Despite revenues doubling over the last 5 years, they've still been able to reduce their costs on a relative basis. Also, $30 billion of debt has been repaid over the last 5 years, with another $18.5 billion coming over the next 5 years. They can more than handle that. They have a ton of cash. For a tech firm, they have a very moderate beta of about 1 times, which leads to a very moderate WACC, or weighted average cost of capital. That's the discount rate that we take those future cash flows and discount them back to today. Also, very low leverage. Only 2% of their capital structure is debt, and they have a AAA credit rating, which is better than the United States of America. So what's the payoff? Conservative assumptions are going to give us conservative results. If you're finding this helpful, please hit that like button. Let's dive into the model. All right, guys. So what I want to focus on here is, as I mentioned, their cost as a percentage of revenue. If you look back 5 years ago, it was 57% of revenue were their 3 big buckets of costs. Now it's only 52%. So they've shaved 5% off of that. And when you're talking about revenues of over $200 billion, that's like $10, $11 billion worth of savings. Tremendous. I mentioned also over the last 5 years, their debt paid down about $30 billion. They've got another $18.5 billion over the next 5 years. They're going to easily be able to handle that. So as we do typically with our DCFs, we have 3 scenarios: bear case, base case, and bull case. We're running this at the base case. One of the cool things I can tell you is this company does not have a massive variability in their costs. They have a very, very tight grouping over time, which gives us a much more accurate number. All right, then we come to the risk-free rate. This is FVX, the 5-year risk-free rate, because it's a 5-year model. Their beta works out to be 1, which is basically the beta for the market. The stock's 4x'd over the last 5 years, 11x'd over the last 10 years. Market risk premium of 4.13. We get a cost of equity of 8.51%. As I mentioned, they have a super, super high credit rating, AAA. So they have a very low pre-tax cost of debt, just under 5%. Post-tax cost of debt, 3.92. Super low leverage. So they end up having a weighted average cost of capital of 8.4%, which is very, very modest. Also, a few other things to note here, guys. They have $81 billion in cash and cash equivalents as of the most recent quarter. They also have associate investments, which are investments in other companies of $13.4 billion. And then lastly, a very important thing to remember is the model. At the end of the model, we have a terminal EBITDA multiple, which drives the terminal value. So we have a current TEV to EBITDA of 26.3 times. So we're going with 26 times for their terminal EBITDA multiple. All right, next thing we have to talk about, DCF, discounted cash flow valuation. So we ran 3 scenarios. We have a bear case, a base case, and a bull case with the current model at base. Remember, future cash flows are going to be discounted back to today. To get to TEV, we strip out net debt to get to equity value. Now, this is a company with high growth, lots of cash, big investments, big push into AI, but is it worth buying today? Now, Wall Street has Microsoft at an average value of $470 per share, which is about 11% discount to the current closing price. Let's hop into the model. All right, guys, the moment we've all been waiting for, the DCF. So we have EBITDA, we strip out DNA, that gives us EBIT, strip out the cash taxes, we get EBIT or NOPAT. We add back DNA, we have the changes in operating working capital, strip out CapEx, that gets us free cash flow to the firm or unlevered free cash flow. We get a terminal value, that's that 26 times the terminal EBITDA for a little more than $5 trillion, truly remarkable. We take these cash flows, we discount them back to today at the discount factor for a total enterprise value of $3.8 trillion, but we don't end there. Remember, we have to get to equity value. So we have the TEV to equity bridge. So we strip out debt, add back cash, strip out non-controlling interest, add in associate investments. We divide it by the current shares outstanding. That gives us an implied share price or an intrinsic value per share of $515 versus the current share price of $426. That's a discount of almost 21%, which definitely is a buy. Remember, if it's greater than 20% discount for us, it's a buy. Between 0 and 20%, it's a hold. And obviously, if it's a premium, it's a sell. That's the rule of thumb on Wall Street. All right, guys, next we have the sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. So we sensitized revenue growth and CapEx intensity, as well as weighted average cost of capital and the terminal multiple. Here's the interesting thing. 56% or 28 out of 50 models gave us a buy. 44% or 22 out of 50 models gave us a hold, and 0 showed a sell. We ran each of the 3 scenarios equally weighted, and we got a weighted average value about $521, which is a 23% discount. So what is the punchline here? Even utilizing very conservative assumptions, we show a buy rating for the stock. Let's hop in the model. All right, guys, as I mentioned here, green everywhere. So 56% of the scenarios show a buy rating, 44% show a hold rating. So green buy, yellow hold, red sell. If we go down further, we see our scenario analysis where we basically run each of the 3 scenarios. And when we run each of the 3 scenarios, we have the bear case, the base case, and the bull case. We run them at the same probability, a 33.33% probability for each. We get a weighted average value of $521. That is a 22% discount, which definitely shows a buy. We only have a sell in the bear case, which is actually a pretty extreme case. And we have a buy in the base and a buy in the bull. All right, guys, so here's the wrap. Wall Street has Microsoft at an average of $470 of value per share. That's about 11% discount with a high of 600. That's 41% upside, a low of 400, which means it's overvalued by about 6%. Now, our analysis here showed Microsoft at a value of around $520, give or take, which is about 22% upside. Now, while you should seek the advice of an investment professional always, it's important for me to note that I was so impressed while conducting this analysis, I bought a small position in Microsoft. The valuation is compelling, and I'm betting on the largest company in the world, flush with cash, betting big on AI, and that's something that I feel very comfortable doing. With over $100 billion of cash, a AAA credit rating, their partnership with OpenAI, and $100 billion earmarked for AI, I feel that Microsoft is in the pole position of this AI race. Now, if you like this, I want to see another tech valuation, check out my NVIDIA model over here or my Apple model over here. And if you find this valuable, please share with someone who you think would enjoy this. Be relentless.